Okay, welcome back, students. We're almost finished with this chapter. It's been a long chapter, a lot in here, but we're going to finish it with this video, I think. So we were up to the decision maker's perspective on page 684 in your text. Few things I want to point out to you. One, right down here, the way an investment is accounted for affects net income, investment book value, and the amount of gain or loss recognized when the investment is sold. Now remember, it affects what year many of those things are reported in. Ultimately, the total amount of gain or loss is the total amount of gain or loss. It's just what year it shows up in is affected by how we account for it. Accounting method does not affect cash flows, but it has a big effect on net income in current and future periods. Also, because the accounting method affects the book value of the investment, it affects gain or loss on sale of that investment. Now, move on down here. One strength of the equity method is that it prevents the income manipulation that would be possible if a company recognized income when it received dividends and could significantly influence an investee to pay dividends whenever the company needed an income boost. I mentioned that earlier. Over here in the margin, managers may structure equity investments to qualify for their preferred accounting approach. Yes, that happens all the time. There's actually nothing illegal or immoral or unethical about that. That's just the way the world works. Right here, this gets into some of what we were talking about there. A benefit of fair value accounting is that it prevents managers from timing the sale of investments to recognize gains or losses in particular accounting periods. Down here, they get into the fair value hierarchy. A concern with fair value accounting is that management has much discretion over fair values and may be able to estimate fair values, may not be able to estimate fair values accurately. Yes, that's a problem where you're dealing with an investment in a company that's not publicly traded. They talk a little bit about derivatives here. Derivatives get their name because they derive their value from something else. So, for example, derivatives are commonly used as hedging mechanisms to try to control future prices. So, for example, an airline may make a deal with some supplier of jet fuel to buy fuel for the next 10 years and set an upper and lower limit on the price. So they're kind of guaranteeing the company they're buying the fuel from a guaranteed minimum price to try and prevent having to pay an unreasonably high price should oil prices spike. So derivatives happen all the time. Common in electric generation, they will hedge their natural gas price, for example. So you'll get into those in intermediate 2 or advanced, I think, a little bit anyway. Let's see, what else do we want to look at? So that gets us down through the end of the chapter, except for the appendices. Appendix 12A on special purpose funds. Where I'm not going to talk about that. Gets into life insurance and some things like that, and not something I'm going to get into. And then in the Appendix 12B, they get into the whole discussion about credit losses. for held to maturity and available for sale securities. And remember, for both of those, any credit loss, well, let me just read part of this. And this is true for both held to maturity and available for sale investments. Companies recognize credit losses for held to maturity investments the same way they recognize bad debts. For a note receivable, they use a contra asset account, an allowance for credit losses, to reduce the carrying value of the held to maturity investments to the net amount expected to be collected. Each period, they report whether credit loss expense, or equivalent to bad debt expense, and that does show up on the income statement, or recovery of credit losses is necessary to adjust that allowance to its appropriate balance. Now, any change in that credit loss estimate is a change in estimate and accounted for as a change in estimate, which means in the current year and in future years, currently and prospectively. So there they show the entry, debit credit loss expense, and that does show up on the income statement, and credit the contra asset account allowance for credit losses. Now, credit losses and available for sale securities, the accounting is a little bit more complicated because of the mark-to-market concept and the gains or losses reported in other comprehensive income. But FASB requires that investors calculate credit losses for available for sale security investments using the discounted cash flow approach shown in illustration 12B right up here, same way it's used for the held to maturity investments. And accounting for credit losses complicated by the fact that available for sale investments must be carried at fair value with the unrealized gains and losses shown in other comprehensive income. Now, the difference here is that the credit losses, if you think you will have to sell the investment before you can recover those, if you think you can recover them, credit losses go to net income, whereas other reductions in the fair value go to other comprehensive income. So, and here they get into the calculation of the credit loss and why it's different from the total reduction in fair market value or fair value. The credit loss calculation requires that the discount rate be the effective interest rate as of the date the investment was purchased. However, fair value calculation uses the current discount rate appropriate for the investment. So those rates could be different and give rise to different amounts of loss. There's a flow chart that gets into when you have to estimate a credit loss. And so if the fair value is fair value less than amortized cost, if the answer is yes, in other words, amortized cost is bigger than fair value, then does the investor intend to sell the investment? Or is it more likely than not that the investor will have to sell the investment before fair value recovers? If the answer is yes, if the investor intends to sell the investment, we recognize the entire unrealized loss in earnings and reduce amortized cost to fair value. In other words, we don't need to deal with the credit loss there because we're worried about we're going to sell the investment. We have to go ahead and recognize the entire loss in net income immediately. If the answer is no, we're not planning to sell it, then is some of the unrealized loss credit loss? If the answer is no, then the entire loss goes into other comprehensive income. The answer is yes, some of the unrealized loss is credit loss, then we recognize credit loss in earnings, part of net income, and use the allowance for credit losses to reduce the carrying value of the investment. In other words, we use the contra asset account. Okay, and then we recognize the non-credit portion of the unrealized loss in other comprehensive income and use fair value adjustment to reduce the carrying value of the investment. Okay. Down here they go through all of that again. I think I've covered it a couple of times now. So read that. That's on page 691 down below the little chart. But I'm not going to go through it again. Well, I guess I will. It talks about whether you need to sell the investment or not. And so if the investor recognizes the entire loss in earnings if they're planning to have to sell it soon in net income. Okay, that gets us down to the end of the chapter. Credit losses reduce net income. We have one last homework problem and then we will be done. So let me pull up that homework problem. And right here, LED Corporation owns $1 million of Branch Pharmaceutical bonds and classifies its investment as securities available for sale. Market price of Branch's bonds fell by $450,000 due to concerns about one of the company's principal drugs. The concerns were justified when the FDA banned the drug. $100,000 of that decline in value already had been included in other comprehensive income as a temporary unrealized loss in a prior period. LED views $200,000 of the $450,000 loss as related to credit losses, and the other $250,000 is non-credit losses. LED thinks it is more likely than not that it will have to sell the investment before fair value recovers. What journal entries should LED record to account for any credit or non-credit losses in the current period? How should the decline affect net income and comprehensive income? Well, key thing there to recognize is they're going to have to sell the investment before it can recover. So the entire loss needs to be reported in net income. So we're going to have to report the whole $450,000 in net income. Comprehensive income, we'll have to pull that $100,000 out that had been recognized there. So there you get into all that. So discussion, and you can take a picture of that and see what it says. But here's our journal entry. So we're going to debit the fair value adjustment. It would have been credited for the loss when the loss was reported, and credit reclassification and adjustment. And then, so that gets the $100,000 out of other comprehensive, accumulated other comprehensive income. And then we are going to have to recognize the loss, the whole $450,000 in net income. And so we credit discount on bond investment, a contra asset account to the bond investment account. Okay, so in the income statement, $450,000 will be shown as an impairment loss, and the $100,000 reclassification adjustment will increase other comprehensive income. So net effect on comprehensive income is decrease of $450,000, increase of $100,000, so decrease of $350,000. That ends our videos for Chapter 12. I hope you do well on it. Good luck.